Dallas home prices just dropped 4.6% in Frisco and 2% in McKinney, but foreclosures are up 22% countywide. Is this the perfect storm or a golden window for strategic buyers? You know what they say, cash is king when markets crash. And if you're waiting for the bottom, you might already be too late. In this video, I'll show you exactly where the smart money is moving, which suburbs are delivering 6% plus rental yields, and how to outmaneuver institutional buyers before the next rebound hits. Stay with me, because in the next few minutes I'll reveal the data, the strategy, and the timing that could define your next big move. So, what exactly is going on in Dallas? Let's start with current conditions. According to CoreLogic, Dallas home prices have softened just slightly, sitting at a median of $413,000 in Q1 2025, down 1.6% from the 2024 high. But that headline number hides a more complex regional story. In Frisco, prices have dropped by 4.6%, currently at $515,000, while McKinney sits at $470,000, down 2%. Meanwhile, Plano has held steady at around $450,000. These are not deep cuts, but they are enough to shift momentum. Take a look at this chart. Suburban Dallas price trends, 2023 to 2025. And you'll notice something important. We're not in free fall. We're plateauing. That's a critical distinction for timing your next move. Now, what's driving this shift? Three major forces. First, interest rates. The Federal Reserve's holding at 4.5 to 5%, pushing 30-year fixed mortgage rates to 6.7%. That's crushed affordability across Dallas. According to the National Association of Realtors, the city's affordability index is now 90, well below the neutral 100 level. Second, inventory. Supply across the Dallas-Fort Worth metro has risen to 4.5 months, with Plano at 4.8 and Frisco at 4.6. That's a far cry from the 2.1 months we saw at the peak in 2022. More choice means buyers can negotiate harder and sellers are blinking first. Third, foreclosures. Adam reports 4,500 filings in Dallas County in Q1 2025, a 22% year-over-year jump. The hotspots? Mesquite and Garland, where delinquency rates are now above 4.5%. We're not in 2008 territory, but for cash-rich investors, this uptick means new opportunity. And check this out, foreclosure filings by suburb, Dallas Q1 2025. It's a clear indicator of where the pressure is building. Now let's talk about the impact this is having on the broader market, and why institutional capital is sniffing around Dallas again. In 2024, REO properties, those repossessed by banks, accounted for 25% of all distressed sales in the Dallas area. This surge has triggered renewed interest from firms like Vanguard and Invitation Homes. Vanguard, in fact, picked up 15% of all suburban REOs in Q4 last year, focusing heavily on mid-tier properties in Frisco and Allen. You know how this goes. When big money moves in, the window for individual investors begins to close. But here's something investors often overlook. While home prices are softening, rental demand remains strong. In McKinney, median rents are around $2,200 per month, translating into 6% gross yields on a $450,000 property. In Plano, it's slightly lower at 5.5%, but with more stable tenant profiles. Renters aren't going anywhere, especially with mortgage payments now outpacing rent by nearly 40%. Take a look at this chart. Rent versus buy cost comparison, Suburban Dallas 2025. And you'll see how renting still dominates short-term economics. So, what are the real opportunities here? Let's break it down. First, distressed asset plays. Investors with cash should be looking directly at REO listings in Mesquite and Garland, where properties are being sold at 15 to 20% below market value, according to Zillow's Q1 data. Speed is key here. These homes don't last long on the market, especially when institutional players are bidding with all cash offers. Second, the rent-for-yield strategy. Buying in areas like McKinney, where gross yields exceed 6%, allows investors to hold through the correction with solid cash flow. A typical rental here can generate $20,000 in annual net income after expenses, enough to justify holding even without price appreciation. Third, outmaneuvering institutions. Here's the trick. Funds like BlackRock typically don't touch anything under $500,000. That leaves a wide-open lane in the $350,000 to $450,000 bracket. Redfin data shows that 55% of Plano's cash sales under $450,000 went to individual investors, not funds. That's your zone of opportunity. Now, if you're watching from the UK, Australia, or Canada, there's an added angle: currency leverage. A $450,000 USD home in Dallas is around 340,000 British pounds, or 610,000 Canadian dollars. That's attractive pricing compared to flat markets in Sydney or softening values in Toronto. Just watch out for the usual tax considerations: FIRPTA for US property sales, SDLT on UK transfers, or CGT on Australian exits. And here's the wild card: timing. According to JP Morgan, we could see a further 5% correction in Dallas by Q3 2025, especially if unemployment climbs above 4.5% and rates hold. That would put more pressure on leveraged sellers and more inventory on the market. Take a look at this chart: Dallas price forecast, Q3 2025. It's one of the best indicators we've seen for identifying the likely bottom. But don't wait for perfection. If you're a seasoned investor, you know this: by the time the market hits bottom, it's already crowded with capital. That's why high net worth buyers are starting to move now, not to chase a low, but to secure yield and optionality. And here's a case that proves it. In 2024, Invitation Homes, a $20 billion U.S. REIT, acquired 800 homes across Plano and McKinney. They paid 12% below market, closed 70% of those deals in cash, and locked in 6.2% net yields. Their long game? Hold, rent, and ride the 2026 recovery wave. Now ask yourself this: if you had $1.5 million in capital sitting on the sidelines, how many of those deals could have been yours? Later in this video, I'll show you which Dallas suburbs are projected to outperform over the next 18 months, and how to build a portfolio designed to scale in a post-recovery market. But first, let's drill down into one final piece. What are the tax-efficient, legally sound ways to structure your Dallas investments as a non-resident buyer? We'll cover that next. And before we wrap up, I want to leave you with one last strategy that's proving effective for investors in 2025, even in this declining market. It's about front-running the recovery. We're seeing savvy investors quietly accumulate properties just below institutional thresholds, well under $500,000, then holding for 12 to 18 months while collecting strong rental yield. When demand rebounds in late 2025 or early 2026, they'll already be positioned. No bidding wars, no financing delays, and no race to deploy capital under pressure. From what I've personally seen working with investors in Plano and McKinney, the ones who act early, while others hesitate, are the ones locking in the best deals. You know how fast things move in this market. Waiting too long can cost you not just profit, but momentum. So let's recap the key takeaways. First, foreclosure rates are rising, but with them come real acquisition opportunities, especially in Mesquite and Garland. Second, institutional buyers are already positioning. They're not waiting for headlines to call the bottom. Third, rental yields remain solid, especially in McKinney and Plano, where gross returns above 5.5% are still realistic, even as prices soften. Fourth, non-resident investors from the UK, Canada, and Australia can still find strong currency leverage and competitive pricing, but smart tax planning is key to keeping those gains. And fifth, speed and structure matter. Cash is king, yes, but so is strategic execution. Delaying may mean watching the best deals disappear under a wave of capital. So, let me ask you, where do you see the greatest upside in 2025? Are you actively buying, or are you still watching from the sidelines? Drop your thoughts in the comments below. I read every one of them, and this is a space where serious investors share real perspective. And if you don't want to miss the next wave of profitable real estate opportunities across the US, UK, Australia, and Canada, hit that subscribe button now. Like this video if you found it valuable, and share it with someone you know who's thinking about making a move in real estate this year. At EstateScope, we go beyond the headlines, because when the market gets complicated, strategy is everything. I'll see you in the next one.